Profitable public corporations frequently provide excess cash to shareholders in the form of dividends. Stock buybacks, also known as share buybacks or share repurchase initiatives, are another option for companies to reward their investors. What are stock buybacks? A stock buyback occurs when a publicly traded firm spends cash to purchase shares of its own stock on the open market. A corporation may do this in order to return money to shareholders that it no longer requires to fund operations and other investments. A stock buyback occurs when a corporation buys shares of stock on the secondary market from any and all investors who wish to sell. Shareholders are under no obligation to sell their stock back to the company, and a stock buyback is open to all holders, not just a certain group. When a public company decides to conduct a stock buyback, it typically announces that the board of directors has approved a repurchase authorization, which specifies how much money will be allocated to buy back shares, or, alternatively, the number of shares or percentage of shares outstanding that it intends to buy back. Why do corporations repurchase their own stock? Companies purchase back their own stock primarily to create value for their shareholders. In this example, value refers to an increasing share price. The way it works is that whenever there is a demand for a company's shares, the stock price rises. When a firm buys its own stock, it helps to raise the price of its stock by increasing demand, providing value for all owners. Maximizing shareholder value is one of corporate America's top priorities. This idea states that a corporation should always strive to provide the best feasible returns to its investors. Companies optimize shareholder value by increasing the value of their shares and returning cash to shareholders in the form of dividends and share buybacks. While dividend payments are perhaps the most prevalent means to return capital to shareholders, stock buybacks have some advantages. Directly increase share prices. Any share repurchase program's primary purpose is to increase the share price. The board of directors may believe that the company's shares are cheap, making now an excellent moment to purchase them. Meanwhile, investors may interpret a buyback as a statement of management confidence. After all, why would a corporation want to buy back stock that is expected to lose value? Tax effectiveness. Dividend payments are taxed as income, but rising share values are not. Holders who sell their shares back to the company must naturally pay capital gains taxes, but shareholders who do not sell benefit from a higher share value and no further taxes. More freedom than dividends. Any corporation that starts a new payout or boosts an existing dividend must continue to make payments in the long run. This is because they risk lower share prices and disgruntled investors if they reduce or cancel the dividend in the future. Meanwhile, because share buybacks are one-time events, they are considerably more adaptable management tools. Dilution should be offset. Growing businesses may find themselves competing for talent. If they grant stock options to employees in order to retain them, the options that are exercised over time increase the company's total number of shares outstanding and dilute current shareholders. Buybacks are one method of mitigating this effect. How do stock repurchases affect a company's value? Stock buybacks have a wide impact on the primary measures investors use to assess a public business because they remove cash from a firm's balance sheet and potentially reduce the number of shares outstanding. It's critical to realize that whenever a corporation buys back its own shares, they are either canceled, thus permanently reducing the number of shares outstanding, or kept as treasury shares by the firm. These are not classified as shares outstanding, which has ramifications for several critical financial fundamentals measurements. Earnings per share, EPS, are determined by dividing a company's net profit by the number of outstanding shares. Reduce the number of shares outstanding, and you've given a corporation a greater EPS, which may create the impression that the company is operating better. The same is true for the price-to-earnings ratio, PE ratio, which assists investors in understanding a company's relative valuation by comparing its stock price to its earnings per share, EPS. Let's look at the top 5 largest stock buybacks announced in 2023, in terms of total cash amount. Apple Inc. AAPL, April 4, 2023, $90 billion. Chevron Corporation, CVX, on January 25, 2023, $75 billion. Salesforce.com, CRM, March 1, 2023, $20 billion. Applied Materials, AMAT, March 13, 2023, $10 billion. UPS, United Parcel Service, January 31, 2023, $5 billion. Stock buybacks have drawbacks. Many critics of stock buybacks argue that they are a terrible way for corporations to produce value for their shareholders. Here are some of the disadvantages of stock buybacks. Stock buybacks may prioritize short-term gains in share price when other more beneficial uses of capital are available, depending on a variety of reasons. Investing in R&D or simply hoarding cash for a rainy day may not improve share prices, but it may provide superior value in the long run. Share buybacks financed by debt. In the years preceding the COVID-19 outbreak, almost half of all buybacks were financed through debt. Low interest rates encouraged corporations to borrow money to spend on share buybacks in order to boost stock values in the short term. Many critics believe this was a particularly short-sighted plan. Stock prices of cash-rich corporations tend to be high. Following a period of strong success, some corporations that initiate stock buybacks have amassed a cash war chest. Companies in this position also have very high share prices, implying that they may produce less value for shareholders than alternate uses of cash. Used to disguise executive stock-based salary. Many public firms compensate managers with shares, which dilutes other shareholders. Executives may utilize share buybacks to conceal the impact of this type of pay on the company's share count. What stock repurchases mean for you? Consider this if you invest in individual stocks and are unsure whether a stock buyback is good or bad news. If a public firm is operating well, has cash on hand, and its stock is inexpensive, a repurchase could be beneficial to shareholders. However, repurchasing stock while ignoring other elements of the firm or holding back on investing in future growth is a mistake that will likely cost shareholders value in the future. If a firm's stock is overpriced, shareholders like you would be better served if the corporation kept the cash on hand for a rainy day. What do you think about stock buybacks and how they may affect your own investments? Leave a comment below. Take care and remember that your money matters.